Welcome to the Wyckoff Starter Sequence series on distribution. This will take us through the process of the market marking up to the process of distribution. We'll explain the markup in the market because we need to see how this process goes from the up movement and how it goes to the process of distribution. We'll have three charts in this particular sequence, and we'll go through this very carefully to show what the advantages of the distribution process is as far as the execution of trades, as well as where the important areas lie in this particular chart. As we can see, when we start all the way on the left-hand side of this particular chart, we will see that the market is in a defined uptrend. We define that uptrend is by a market that makes a series of higher highs and higher lows. Many times in this sequence of the up move, we will see that the market will have increasing volume on the rallies, but that's not necessarily the case. Many times when the market will break in this sequence, we will see a sharp, quick move down with no follow-through and increasing volume, indicating that the longs are getting knocked out of the market. So let's begin with the process of this beginning. But first, before we begin that, we'll do our disclaimer. There's substantial risk of loss in trading commodities, futures, and options. Past performance is not indicative of future results. The opinions expressed here are those of Gary from LTG LLC, not to be taken as recommendations to buy or sell commodities, future options. This is for educational purposes only, based upon the teachings of Richard D. Wyckoff. So as we can see, we'll begin this process in May at the low of this, in one of the lows of the particular chart. We will see that the market will have an up bar here, and we will mark this bar, and we will show you that the market at this level will have a situation where the market will go up on increasing volume. This is a strong market, healthy market, in which the market gets demand from lower levels. As we know, or as you may not know, the composite operator tries to buy value at lower levels. These lower level buy is that the market is defending the support or defending the area that he feels that the market has an area where the value comes into the market. As we can see, many times in this process, we can see that the market immediately reacts to the upside. As we can see, the market then has a point, it increases the volume to the upside again, increases the volume to the upside of the market. These will show you that the up bars that we see are greater than any VEX in the market. This is a market that has, which we the tape, means that the market is accepting higher prices, and the market's in the markup phase. And the market is in the markup phase, it's considered the right-hand side of the particular market. As the market continues to go higher, we will see that the volume begins to increase, and this is mostly because the rollover volume that goes from July into the September contracts in cocoa. So it's not always so meaningful to recognize the high volume in the area of rollover. As you can see, the market has a portion, a bar, where the market goes down on very high volume. Again, basically most of it is rollover, and it closes on the low end of the market. One of the characteristics of this particular market is that the follow-through to the downside in the bull market does not have follow-through. Or if it does have follow-through, there is really not a supply aspect to the markets. So, when we talk about supply, we talk about a market that has wide range and large volume, as compared to a market that has smaller range and smaller volume, which would just be selling. So this would be considered in the market phase a selling bar with the increasing range and increasing volume. And this would be considered a sell. My error. Making this selling bar. Okay, and this would be a selling bar with the market going down and the volume not being as high. This would be considered a supply bar. My apologies. A supply bar, which is characterized by the larger volume and the larger range to the markets. Okay? So, as the market continues higher, we see the market has a wide bar, and the market does not have follow-through to the downside and forms some type of range. Well, we determine this range by the previous lows, and we determine the range also by previous highs. This particular market here. So we can see that the market has developed a trading range from this level. Okay? This trading range in an uptrend is a trading range that is part of the accumulation process. And in one of the sequences, we will definitely go to the point where we will see the market in our starter kit. We would see that the accumulation and distribution process more clearly, and this is not the place for it. So as we can see that the market continues to go higher into the range, and it goes higher, and again, we see the volume increases to the upside, during this mark-up phase. This is a market that's a healthy market. This is a market that gets bought on breaks. This is a market that has a sequence of higher highs and higher lows. It's a very healthy market. There is no supply that comes into the market, and there's no cause for the market to also mark down. So we consider this a healthy market. So the market continues to go higher, and as many of you are aware, that this is called vertical absorption, when the market just kind of grinds higher with no retracing lower. The market just builds upon in a situation. We call this section of the market called vertical absorption. Okay, vertical absorption, where the market just kind of grinds higher in an up channel that goes higher. Again, with there's no supply that comes into the market, this market considers to be a healthy, strong market. Market becomes a very healthy, strong market. Until we get the first inkling of selling that occurs into the market. And we can see that selling is that we have an established high in which the market has come down from a high. So we want to mark this particular high in the market because it is an area in which the market has reacted lower from. So we will draw this line right here because this market at this point has made a new high and has come down to this level. So that is a section where we can mark where this selling bar is marked as resistance. Then we mark that bar and we keep that bar. We tend to draw these lines from selling bars for the resistance area. When the market rallies, we will consider to the upside to the bar, we will consider an up bar to be a lower range bar, and we'll consider the ICE support. But at this point, we'll just suffice to say this is the creek. We will see that the market will go above this particular high and then close under it. So we can consider this an up thrust of this particular recent high. And an up thrust is simply a market that goes above a previous high and close under that particular high. In this case, the close is down here, so we can quantify that as a true up thrust in the market. An uptrend and up thrust is not ending action. It is a market, is a probe to go higher, depending upon the subsequent behavior that occurs on the right-hand side. As the market then continues to retest the back high, back higher, we will see a market that will come to an area where it will try to retest the up thrust level. So, as the market attempts to go higher, what occurs is the market again, once again encounters selling. So we have selling from the up thrust area, and then we have selling that occurs afterwards. This volume is not substantial. So we look at that as selling at this point, but we don't look at that as particular ending action of the particular trend. The process is an upside, so we do not have any cause that is built in the markets to sustain the down. Cause is simply a sideways behavior that we have that will cause the move to go either up or down. It's equivalent to a car with gasoline. If you have a car that has a quarter tank of gas, it can go only a certain amount of distance. If a market has got a full tank of gas, that distance is substantial relative to the quarter aspect of that market. So, this is how a market will also kill demand, because we know, as discussed a few minutes earlier, in the markup phase, the market will get bought at lower levels and begin to mark up. In the down phase, or the distribution phase, we will see that the market will have these selling bars, and I like to call them selling tails, that occur in the market. You see the market, the upthrust is a selling tail that goes up, that closes here. The market that retest then has another selling tail, and the market closes on the lows. So the first substantial break from an uptrend, we can label it the possibility of the terminology of preliminary supply. It is the first selling that occurs in a market that's an established uptrend. This break of this preliminary supply is when the market, by the composite operator, feels that the market is getting to a point where it has some type of overvalue in the market, and he begins to sell his longs that were established during the uptrend of the markets. So we can see that the market being in the uptrend, the composite operator is long, riding the trend up, riding the trend up, riding the trend up, until the composite operator begins to sell. He begins to sell his longs at the preliminary supply level. It is the way that the composite operator will signal to other composite operators that the particular trend, the uptrend, is soon coming to an end. But we have to understand the story, and we have to have the process that the market must go through to have that cause to be able to build, to sustain the market to go lower. This particular break that we have from the preliminary supply will generally take us to an area where the market will go to some area of support area. So if we take away some of these lines that we previously put in there, as the market goes forward, we can see that this market went to the point to where the preliminary supply went to the area of a previous sort of support area in the market. And in trading, we don't look at one particular number as being anything. We don't think of an area as value. We don't look at one price as value. So I had written the preliminary supply here, but because of the possibility of the market having that first substantial break here, but it's very important that we put a question mark here, because we don't know if this particular move that we have here is the beginning process of the market ending action, or if it is a move that the market will break on some particular move, go up and make new highs, and consider it to be a shakeout. The difference between a shakeout and a market that has supply in the market is the fact that the shakeout will go make new highs and will continue higher on its merry way. In this particular case, we don't know what this says right here. We do know that the market did have some selling that occurred in the market, and also supply. And the supply comes in from the fact that we see a bar, a very large bar to the downside with the highest volume. And when we deal with volume, we deal with volume within an area of the market. So you can see that that volume on that particular break is substantial. The range is substantial to the downside. And we can see that this market now has had supply that came into the market. So once we begin this flattening out process of the supply process, we consider this the left-hand side of the trading range. Okay, it's where the market has stopped to become the point where the market has stopped going up. The market has some type of correction, and then we will build some type of cause we build with this left-hand side being somewhat of the resistance area in the particular markets. We can see that when in a market that's in a bull market, we do not want to sell the first break that occurs in the bull market, simply because this break that occurs in the market has no cause that's built up. It doesn't have enough gas in the fuel of the car to sustain the market down. This cannot be distribution or looking for lower prices, because it's during the markup phase. So we can have the sideways action as possible distribution to go lower, simply because it's going sideways and it's built an area in which the market has simply gotten to a point where this sideways action, if it goes down, can be considered some portion of distribution for lower prices. So we do not sell the first break in an uptrend because we do not have the cost to do so. This causes a lot of the break causes the sell stops to get hit as the market begins to make lower lows. So if we draw the line from this reactionary low here across here, we can see once the market goes under this particular low that all the people that bought the market here have now become trading losers in the markets. Okay, that's very, very substantial because those longs have now been wiped out. So the latest longs that come into the market are the first longs to get out of the market because they're the ones that show the loss in the market and maybe potential market margin calls that may occur in the market. So generally in a bull market, the market will get bought by specs and will get bought by funds on the market when they find support. In a true bull market, the market will be bought by the composite operator, strong hands, and they'll have an opportunity to buy the market at a cheaper price so it can establish a situation where the market simply can go higher. In this particular case, the market has a sharp reaction to the upside. And this is very substantial that the market has a rally to the upside simply because this is the rush to the market of buyers to come into the market because they see an opportunity that the market's been at prices that it had not been for a while. They're able to buy the price at cheap prices. They gobble up the price in a very, very quick fashion. And what has happened was that the greed factor of the market of missing the boat comes into the market. So this is very, very important and very, very important process of the particular market. We can see this market going higher. We can see this market doing it in a very quick fashion, very typical of what we consider ending action or the particular buying climax that may occur in the market. So this is a rush to the people to go in and to buy this particular market simply because they do not want to miss the boat that occurs into the market. So people that have been waiting on the particular sidelines have gotten to a point where they now have the opportunity to do so. This is very important because what happens is when the market begins that initial break, the longs get out of the market, the shorts get into the market, and there's a transfer risk that occurs. It is during this preliminary supply process that occurs in the market in which the composite operator who has been long all the way through the process of the up move or the markup phase, he begins to sell his particular longs into this market. As the market has established new highs, the new highs bring in the fund that expects to buy it, and he's able to sell his long positions in a very, very favorable price because as he's selling into the rally, the fund specs are buying it from him. This is a transfer of risk that is extremely important in the market. Does he unload his whole long position? The answer is no. And the reason the answer is no is because if he has very large position in the market, it'd be very difficult for him to do that, for the market to do that, and to get out of everything without the market getting to the level in which it would basically panic the market or the market would have a free fall. One of the jobs of the composite operator is to provide liquidity against the funds and the specs, so he takes the opposite side of the particular trade. And we can see that clearly here. He's able to sell the market at a high-end price. Him selling the market causes the sell stops to get hit, causes those who bought the longs to get out of the market and the process to go down. The market then begins the upside to the potential buying climax because this buying climax cannot be determined until the sign of weakness occurs on the right-hand side of the market, which would establish as we go through this lecture. The market then has a situation where the resistance now becomes some type of support when it gets above it. So this line becomes a valid line to the market. If this market was going to continue to be a healthy market, the area that the market should have been contained in was the upper third or upper half of this particular range. That would be called a process called absorption. The fact that the market sold off from these particular highs is troublesome to the bulls because the market is not staying near the resistance in absorbing any supply or any selling that's occurring. The market has some selling, and the market's been able to mark down in this particular phase. That markdown through the selling becomes where the longs get out of their positions as they reestablish them above new highs. So as the market then continues to break, we will see a very wide bar here that has a bar with large volume, large range, the highest we've seen in many, many months, and that establishes that supply is truly entering into the market really for the first time of the market. It is the widest bar to the downside, as well as the largest volume to the downside, as well as the largest volume and the largest range. Indicates selling in a place to where the market really should have been establishing buying in the area of the higher ranges, which the market did. This is caused by the composite operator not supporting prices as support, pulling their bids, allowing the market to work lower. And as the market works lower, the funds and the specs who are long, making new highs, they tend to aggressively get out of the market. Okay. Then the market will continue to go down. Market will continue to go down, and it will form some type of retest back to the lows. Okay? So since the market went this low area down here, we will mark this area right here, because now that the market has made this particular low, this is the low before the high of the market. So it becomes a very significant area in the market. The low before the high in the market is significant. It's a place where Wyckoff established that the market will have markdown phase in the particular sequence of order. So the market goes back here, goes back down to the support area, and what's very important is that after you have a supply bar that enters the market, this is not the sign of weakness bar, but this is a supply bar that occurs in the market. So we establish the left-hand side of the market. We establish the potential of the buying climax, which is more of the middle of the market, range-wise, as we do that. And then we have a market that has clearly supply enters the market. At this point, where the market has that supply volume after the new highs, that we can consider the preliminary supply, the buying climax aspect, has more validity. It will only have validity in the long run when the market has a sign of weakness on the right-hand side, which the market has not had yet, because it needs to have supply first, trading range, and then a sign of weakness on the right-hand side of the market. So when the market then has this supply bar, it's on the onus of the bulls in order to make that support be bought. And that lower level support is bought by the composite operator, who happens to be at a point waiting for prices. The quality of his buying at the support is the key to the market. And when we talk about quality of the key to market, if a market is at the support area, and we will call this ICE support, it's the correct terminology, we will call this ICE support in the market. And it is an area in which the composite operator or strong hands bought the market here because that established a new high for the market. It is also a situation where the market gets retested perfectly for the market. So this retest to the support needs to generate demand by the composite operator, who finds value in order for the market to go higher. So the quality of the rally after we see supply is the main focal point of trend of this particular market at this time. So we have to see the quality of this particular trading range that occurs, and we see that the market has a rally into the resistance area, which was support, into the resistance area, and we see a bar that has a market that closes on the low, and the market has shown selling on the rally. Again, we have a selling tail because the market went higher, closed lower, and forms somewhat of a trail as it leaves the market through supply. Then we get a reaction back down, and we do get a decent reaction back to the upside, and the volume is fair as far as that goes. But now we've established a trading range between this area that was support and now this area that becomes resistance. Very typical of trading, technical trading. As the market then goes up to the market and tries to reestablish the bullishness of the uptrend, we will then certainly see the market get to the point where more selling occurs and we see the volume coming in to the downside. So as the market rallies, this rally has induced sellers to come into the market, take advantage of the weakness of the market, be able to sell the market. Now, as I established earlier, the preliminary supply is where the composite operator begins to sell some of his longs, which causes the market to sell stops and for the market to break. As the market goes to the high end of the market, where the funds and the specs begin to buy the market for the greed factor, this is where the section where this composite operator begins to sell his longs at a very favorable price, which at that point it causes that supply bar and then causes the lower trading range that we have. Okay, so this trading range that's established now in the market can either be accumulation to go higher or distribution for the market to go lower. Well, when we have supply in the background from the sequence that the possibility that we described it as, the lower trading range after we see supply in the market, after the potential preliminary supply and the buying climax, the lower trading range is generally seen as the market going through the distribution phase, and as the market goes higher, the rallies are sold, and the market does not really go up and threaten the upside of the particular market. So we can clearly see that type of behavior that's occurring in the markets. Okay? So, the selling process, so instead of the market getting bought, like we discussed previously, we now see the market getting sold on rallies. That is part of what we call the distribution process in the markets. We have not established the sign of weakness in the market from the trading range. So a sign of weakness can be established within the trading range, and this would be considered the lower trading range. Okay, the lower trading range. We can see this lower trading range that's established, and we can see the market on the right-hand side of this trading range has wide bars to the market to the downside. This we must consider as being the sign of weakness to the markets. It is where the market has this markdown phase in the market that goes lower. The sign of weakness is only on the right-hand side. It's only after the distribution process is taking place, and it's characterized by large volume and large range to the downside. We can see that the market range is wide, and also the volume very high. This high, again, relative to the area that the market is trading in. So that is the classic example of the sign of weakness after the distribution process has taken place. And again, the distribution process has taken place because we have the first initial selling that occurred, the market going up into this potential buying climax, the immediate reaction to the downside of the market, which led to supply, which led to the lower trading range, which led to the right side of the market being at a point where the market now has established a sign of weakness. It is at this point that the market supply has overcome the demand at this point, and then the supply has overcome the demand again. So we talked earlier about the reaction low before the high. and as we establish it to the market as at a point to where that market is at a point to where it's right here, the reaction low before the high is right here. There's the high, draw a line across here, and as I told you earlier, this is where Wyckoff believed that the market should go through the phase of the markdown phase. And as you can see, cocoa continued to go much lower after the market broke the little ice area. So to recap, there has to be a process to what happens in this market, and the process is the preliminary supply buying climax potentially until we see the sign of weakness. Once we see the sign of weakness that occurs on the right-hand side of the market, to a Wyckoff student, we can now position our trades to the short side when we get to resistance. Up until that point, you cannot establish a position to the short side until you see that sign of weakness that occurs in the market. And once we see that sign of weakness in the market, then we see the markdown gets to the point as far as that goes. So, very, 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 very important. Very, very, very important. So this lower trading range that we had, okay, the weakness, without the market taking out the resistance area, ultimately forms the sign of weakness that occurs in the market from the standpoint of the market that breaks. So this is a classical situation of distribution that occurs in the market from the standpoint of weakness in the background, from the aspect, weakness in the background, initially started by the preliminary supply, the selling of some of the longs by the CM, this composite operator or the composite band CM, the market going through the buying climax, having the supply, having this lower trading range that occurs on the right-hand side of this range. So it becomes the right-hand side of this range. And the market forms distribution or a lower trading range, which leads to lower prices in the market. And we consider markdown. So earlier I said the phase with the reactionary low is where Wyckoff determined that that is where the market begins to have markdown. Very important point, because which this allows is that this whole area that the market traded through, instead of being a potential accumulation and uptrend, this sign of weakness has now killed the thoughts of that being accumulation to go higher, and now it's classical distribution to go much lower in cocoa. So we also see that as the market begins to change its character behavior, we now see the large bars taking precedence over the up bars that is happening. That is why it's very important to look at the bar reaction to see if the market is accepting higher prices or if the market is not accepting higher prices. In this particular case, the sharp selling and increasing volume to the downside, the large range to the downside, is the market is projecting higher prices. By rejecting higher prices, they cause those selling tails and they cause the market to actually go lower. So this process that we thought was accumulation, because of the weakness in the background, because of the sign of weakness in the background, we now establish this market as being bearish, and this market is going through the process of distribution, which led to lower prices, which you can see the lower prices occurred right here. So the market then went from a sequence of the preliminary supply buying climax possibility, and then we take off the question mark once we get the sign of weakness of the market. So instead of saying potential sign of weakness, with the question mark, we now get to the point where we can take off our little X's, a little question mark rather, and the market should go lower. So the establishment of the background being weak, establishing the market having a situation where the market shows more downside pressure, upside pressure, where the market then has larger volume and larger range, is demand, weight demand being overcome by the supply. And that's very, 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 very important. And the process of distribution is complete when we go through a sequence of buying and then retest like that. But until the sequence happens, this market will continue to go lower because of the process of the story of distribution that the market established at near the highs. So that's extremely important in the markdown phases. Many times, ideally, we want to sell or retest back this resistance area for the market to do this. And sometimes you don't get that type of behavior simply because why? Simply because the market at this point, has built enough sideways cause in the market that the market is ready to mark down. So we have seen the market have a large trading range that eventually gets broken on the ice. Many times this market would not retest an area of the broken ice area, and the market will mark down. And the trading range to sell will be maybe at a much lower level. But at this point, because the market has established the weakness for a period of time, then the market does not retest the resistance to give us a long-term sequence to get short against that. The train has left, and then somehow, some way, we have to look for the market to get to the level where the market then continues to go down, and we have to look to sell markets that may not be at an advantageous price because we're selling it lower, but that's why it's very important to identify any process of Wyckoff as early as possible so you can put your position on, so when the market does eventually move in your direction, you will see that the market will essentially get it at a good level with a limited risk in the market be established to the downside, and then so many times you can catch the market. It's true that people that tend to stay in positions in a longer time frame, that the trend is more established, and those are some of the times we get your very large profit traders, is when they catch a move from the low end all the way up to the potential buying climax that may occur in the market. Okay? So that's very, very important to go through that sequence, and that's kind of what you see here. So that concludes the section of distribution for the cocoa chart. We still have several charts to go through to show the distribution process of the other particular markets. This chart is very self-explanatory and something that you should really understand. If not, please contact me via email, and we'll be happy to get that out for you, or I'll be able to explain it to you. If we have to hop on, for certainly the time to talk through it, I'll be happy to help anyone that receives these starter kits, obviously to be support for any questions that you may have. So this process at this point is very, very, very clear cut. It's one of the most classical aspects of how a market tops, from the preliminary supply to the buying climax, and then the subsequent supply bar that comes in, the market then going sideways with lack of demand that occurs in the market. The market is not running away anywhere quickly. The market then gets to the point where the market has marked down underneath the reaction low before the high, and the market marks down. That concludes chart 1 for the cocoa. We will now show a different chart, the distribution process that is present, and we will show that this market has distribution in a different realm, because this chart does not go through the process of the buying climax that occurs in the market. This market happens to be one in which the market turned over in a different sequence, and we'll go over that chart right now. So, as we've seen before, if we move all the way to the left-hand side of this market, you will see that the up bars are greater than the down bars as the market is moving itself up. Every time the market breaks, it gets bought, and the market becomes a very, very healthy market. We eventually establish a high, and the market goes lower, so we will mark this bar from the standpoint of the first selling bar, and we will mark the market right there. We also establish some type of low here. We can establish that this is some type of ice support. So we see that the market is now at a point where the market again has shown the process of a trend range that will build the cause of the market. Okay, we can use this chart also as a distribution, the trend range chart. You can see the trend range as well, but not necessarily to the point for this particular sequence of the market that we could do that. Okay, so we will see how that works out, but we can see that the market, that the funds and the specs, how they are fodder for the composite operator when the market's established. So as we can see, the market from this high, if we draw the previous highs as well, we could draw the market does this as well, and we can see clearly that the market went above this resistance area to make a new high for the particular move. That is substantial because the market made a new high, which induces the funds and specs to buy new highs because they are momentum type traders that are occurring into the market. So we have a situation where the market is in a training range, and the composite operator gets to the point to where he begins to, at the new highs, as I told earlier, he gets to sell into the market, and this is where he's able to sell the market at strength at the high. This selling the strength at the high, okay, forms some type of preliminary supply again, potentially, even though it's not that sharp break that we like to see, but the behavior of the pullback is something to watch on the retest. So the market, I'm not going to label preliminary supply because I said some of the charts are not classical, but we can see that the market did get some selling from that high. So we have to see the retest of the market to see if the market begins to show the distribution effects. So the fact that the funds and specs bought new highs in the market, the fact that the funds and specs bought new highs in the market, trapping these longs into the market, the CM selling into it, which causes the market to break, and then the market all of a sudden goes up and makes new highs. So if we consider this preliminary supply, the first break that happened in the up move, again, not classical. Not classical, because it's not the sharp break, but we see the market does break, then the market goes up and makes a new high. So if the market begins to make a new high that occurs in the market, then after potential weakness, we got to consider a preliminary supply. But in this particular case, it's very far from obvious that that's what is happening with the particular market. So we see the market get to the point where the market then breaks down to the markets. So the market breaks down to the markets, and we see the market break and going up to new highs. So we have trapped longs at here. The market here where the CM gets out, where the funds and the specs had bought the market at the high, which established the CM of the composite operator selling his longs at the new highs, forming somewhat of that little upthrust that we talked about previously. This selling of the CM to the market, to the downside, establishes the market to the downside, and when the CM gets out near the highs, as the market comes back down, the longs get out, and all of a sudden when the market makes new highs here, more funds and specs get into the market because they buy new highs in the momentum traders, and the greed factor begins to come into the market that they're going to miss the next leg up. Okay? So instead of the market staying in that upper range in the market, the market then comes to the situation where the market then gets a point where instead of this going higher, it can go higher, we see the market have something that the market now has selling that occurs into the market. Okay? This selling that occurs in the market is very critical because if we look at the market from the composite operator of providing liquidity for the longs, the CM selling into this market, and then the CM selling into it, he went from a position of long, getting out of his longs, causing a break with the funds and specs getting out, and causing here more funds and specs reestablishing their long position in the market. And we can see clearly that long position that was established, that people brought new highs into the market. And we know that by the volume increasing here on the rally, so we know that people have reestablished long positions or shorts have gotten out of the market, and the market goes higher. So instead of the market staying in the upper range that we have, okay, this is very, very important because instead of seeing buying for the markup phase, we do not see buying to the markup phase. As I had said earlier, we could take this out to be a little more cleaner. I could take this market low, this demand bar right here, we would mark it. And why is that important? It is important because it's a wide bar that we mark our support from, but more importantly, this particular low is the low before the market makes a new high. And we saw that in the Cocos chart. The low and the high is where the markup phase begins in the market. Markup phase that begins in the market. So we see that process of the market, instead of going sideways to absorb this any selling that went on, the market gave way to selling. We know that by the action of the behavior of the particular bar. Okay? Now, the market goes back down, goes to the range, and as I said earlier, because the market has established some type of uptrend, we always have to see the market now from the aspect when it goes to that support area. When the market goes to support, does the composite operator defend that support? Does the market go to support? Well, we go and make a low here, and now if we take this low here, we can establish the market from this little demand bar. We can establish that this low held because of this bar. And if we keep our line from the standpoint of the reaction market length, we'll just take this line off temporarily to show the sequence. We can see that the market approached the right-hand side of the market with selling, but not supply, and the market attempted to make a spring. A spring is a penetration of support that the market closes back into the support. Well, we have to look at the quality of the retest of support after we get selling or supply in the background. Well, what do we see? We see the market going to an ICE support area, and the market does what? Well, last time we were here, we went to the low, the market made a high. Okay? So that's very significant because that's our reference point to the market. So, when the market went back down and retested that demand bar that occurred right here, when the market established the trend, would establish that aspect of the market, what happened? Well, what will end up happening is that the market, the reaction to the support, when it comes back down, is much more muted. And the market almost forms some type of hinge in the market, or a bearish flag, whatever you want to call it. But the market is in an up channel after weakness, which is a lack of demand, where eventually the supply will come into the market. As we can see, the market then gets to the level and breaks. Okay? This rally back into the trading range is what we call LPSY. The last point of supply. It is the last time the market has short covering that's coming to the market. It's also to the point where the market has the buyers are dying in the water because they have not, the market made a low under the spring level, and the weakness of the rally here, the lack of upside potential with the volume not being high allows this market to go back into the trade range, selling off, and the market forms LPSY. Here's a quick little retest of the ice area, and the market then breaks. So in this particular case, we can clearly see that a little bit different sequence than the cocoa chart where the preliminary supply was well established. In this particular case, we can see that the market is similar to the last one, but different. Okay, but different. But the point of the matter is that this market now gets to the level where the market then gets to the point, shows that weakness versus the absorption. This trading range that's established occurs very much like accumulation that would occur in the market. The difference is, in this particular case, obviously, that instead of the market reacting with strong vigor to the upside, okay, the market does what? The market essentially does the opposite. It basically has a weak rally back into the ice area, forms an LPSY. It's where the demand is ending. We can see by the volume here. We can see that the volume basically dries up on the rally, showing a lack of demand with selling in the particular background. We have the selling in the background. Once the market gets back to that area of support, what does the CM do? Well, the CM, instead of buying his shares that would occur in the market, the CM says, I'm not really interested in buying that. He pulls the bids away from the market, which allows the market, after the short covering, to fall on its own weight, because the market all of a sudden does not have the composite operator to defend the ice area, because the composite operator feels that the market has reached a pinnacle in prices. He does not want to buy the market as support to defend it. He thinks that ultimately the market is going lower. So again, the CM who was long, sold out his longs here, causes the break. The rally then funds the specs, which is pretty fast and moving, just like the crude oil gets higher here. And then we get a situation where the market has some type of weakness that occurs in the market. Increasing volume from the LPSY, causing the market to go lower to the market, to the downside, and the market then breaks, and then markdown occurs in the market. So we can see, in fact, that the market, from the lack of demand that caused the market, from the lack of demand of the LPSY, and the lack of demand that the market breaks, okay, the lack of demand shows that then the supply comes into the market, and the market then breaks to the market. And we can see lack of demand, when demand should show up. Demand shows up here to make new highs. Reaction low before the high is where markdown begins in the market. Another case of distribution in the market. In this particular case, the distribution occurred from selling in the background to the LPSY, the last point of supply, and the market then begins the markdown process because of the lack of demand. So the lack of demand ultimately gave the point where the market then established it to the downside and to break. And we can see that quite clearly. So eventually, we look at this market as being accumulation because we don't have any weakness in the market. It's pretty large accumulation that would occur in the market. Once the market gets under these reactionary lows, makes a high with weakness, this accumulation process, which appears to be until we see really the LPSY for the most part, and we're cautious with the selling, but more so when the market goes to the LPSY level, we know that the market now is in trouble and the market should break because now we have a different game where the market has now established lower lows from this little ice area into the market. Those lower lows that occur in the market, if you get a sequence of lower lows that occurs in the market, then that shows us that the market then gets to the point where the market then can clear the deck for the market to go lower. So once the composite operator does not defend that support, he allows the market basically to fall on its free reign of what happens. And what happens is once the market goes up, establishes this down, here this becomes the left-hand side of the market, the reactionary high. As we go forward, this is the right-hand side for markup or markdown. As the market goes, so instead of this market making higher highs and higher lows like it did in the process here, and the bars being greater to the upside than the downside, we can see the opposite complete from the market right there. So in this case, rather than being so much clear cut of the selling climax in the market that we thought was accumulation at a higher level, which is the right read to read, once the market establishes this selling, that's still okay because the market has not really shown supply. But once this market gets to the point where it shows the lack of demand, it occurs at the critical ice support where the composite operator should defend the particular market. He does not defend the particular market. He allows that buying to go on by the weak hands, and the market dribbles up higher, forms somewhat of a hinge that occurs, and all of a sudden the market goes down because the lack of demand ultimately led to supply. Many times you will see that, especially in the stock market, you'll see a very small range on the high of the day with volume that's decent, and then when things have a shortening of the thrust, and it could quite be that case, but it's only valid when the market comes through and has supply. So shortening of the thrust are usually continuing action, but if they can stop that continuing action if they get supply that comes to the market. So once you get supply that occurs after the shortening of the thrust, okay, once you get that supply that comes after the thrust, it becomes the market in a whole different limelight. So the market ends up being bullish, but once the demand needs to show up, as the area doesn't, then that makes it bearish, and that makes this trade range, which we thought was accumulation, now the trade range becomes distribution and markdown. And the market breaks, it has some type of test real quickly, market immediately gets rejected in price, and obviously markdown begins in the market, and the market continues to go lower. And that's the process of distribution that led from basically from a lack of demand that ultimately led to supply. So selling market down led to an area where the market had a lack of demand. That lack of demand formed the LPSY market the last time buying. When that buying ended through the short covering process, or people trying to pick lows to get long, then the market eventually has a point to where the market then breaks. In earnest, we get one more retest, and it's Katie bar at the door because of the market establishes and goes down. So a little different makeup from the last chart, but the sequence of selling that occurs on the right-hand side of the market. Right-hand side of the market, okay, when the market ends up going to its trade range, this becomes the left-hand side of the market. And as the market goes through, it builds cause throughout this whole trade range, which we thought was accumulation until this happens here. And since that's happened, there's an action bar that occurs here, where the market makes an up thrust, closes right here. Here's where your action bar would be, the sell, with the stop of that high, and walk away from a particular trade. If it's not LPSY, and it's some type of spring that doesn't look sharp, then you're just out of the market and lose money. But the thing about losing money, if you think it's accumulation distribution, once you're wrong in the market, you could go in the direction of the trend, and that may be over a period of years, that trend. So if you lost on one particular day, in the long run, you make up by reestablishing the position that way as well. So that is something to keep in mind, that the lack of demand can lead to selling / supply, and then when the market selling / supply comes in at support, and the composite operator does not defend the support that you and I like, then it just continues to break down. So, very important sequence of the market going down, but what we thought was accumulation with large range, ended up being distribution to markdown. It's a great chart to keep track of because it really shows the story extremely, extremely nicely. So for our last chart for this sequence, we're going to skip over to the grain market in the soybeans. And we can see the process of distribution quite clear in the market. In the market here, we can see that the market has established in the soybeans a market that has gone up, and we can see that the market has larger ranges to the upside, to the downside. That shows us that the market is a healthy market. We also could tell that any downside or stopping action gets immediately bought. So this is a classical market that has no cause to break. Shows up. And the question is, that is supply. That is a nice selling bar that occurs. The problem is that the market immediately, the next bar here, forms a little spring of the market. A little spring of the market to go higher. So we see that the up bars that are occurring, they're greater in, just like the first chart, they're greater in motion to what happens in the market. So we get to the point where the market then has some selling, so it's not a very threatening type of market, and the market ends up going to new highs. Again, what's critical is that anytime the market went to new highs and had a correction, the market eventually went higher. Now, in this particular case, the market then gets to the high where it's established the high end of the market, and the market, again, instead of absorbing what's around the market near the highs, the market begins to sell off back to the reaction low to the high. So again, this is the low area before the high that gets marked. It is the level in which the bulls and bears will try to break or try to rally the market from. So again, we see the quality of the rally. It occurs on the retest. Well, this rally from these lows took you to new highs. So there obviously was some markets that were enough accumulation-wise to take the market to new highs. So when the market retested area 2, the market at the support level, should get to the point to where what? Should get to the point to where the market then should rally. Should get to the point to where the market then rallies. So, bottom line is, the market goes higher, and instead of, again, another chart in which the market should hold up in the sequence to be absorption, what does the market do? What does the market do? It immediately, instead of holding up the area, the market immediately shows supply that occurs into the market. Then what's very important about the supply, again, is that we establish the reaction low for the high. we want to see the reaction from the low to show the market going higher. What do we see in the particular market? What do we see in the particular market is that we see something that is very, 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 very important, because what happens is, instead of the market going up and make higher highs, see the market making higher highs that are occurring in the market then goes to the original high that we had perfectly. So this is where a lot of people have established Wyckoff-wise, where the market then gets to the point where it forms, they go up these head and shoulders, the left shoulder, head, and the right shoulder here. Okay, they take it from a Wyckoff sequence. In the Wyckoff sequence, we see that the market cannot reestablish where the market got selling from, and we're still in a trading range, and we need to see some type of supply and or demand come into the market. In this case, since the market has established an upside to the market, then we must see a sign of weakness for that market to turn down, because we do not need demand necessarily to make new highs, because the market's in an uptrend. But we will need to see demand come in. We don't need to see a sign of strength, but we do need to see demand to overtake any of this selling process that occurs. So what we have is a market that has selling, but eventually we do not have absorption near the highs. The market breaks. We need to take this high out in order to reestablish the uptrend in the market. So as we get to the point to where our first correction happens in here, the first selling that occurs here, okay, we now know that the situation where this establishes the left-hand side of the market. So redo the chart here. What's the chart? Just give me 1 minute, please. We establish this. Don't know where we lost that. Anyway, we get to the point to where the market now is at a level to where this low that occurs here, and as the market begins to begin in this trading range, we know that we have cause that's established into the market. We know the cause is going sideways into the market, but we are selling in the background, and then all of a sudden the market has a severe downtrend, severe down move to the market. And this is what we established on the right-hand side of the market. And as you well know by now, since you watch this video, this causes the sign of weakness, or SOW, not the pig, but the SOW. On the right-hand side, characteristics by the market breaking down into the market. Wide range, largest volume, classical. So the sign of weakness is a supply bar, obviously. Forms, but only forms on the right-hand side, special type, large volume to the downside, huge volume, huge price range to the market. Market to the market, and that is a sign of weakness. Once that sign of weakness is established, we now get to the point where once that sign of weakness is established in the market, now to us as a Wyckoff trader, we know that this market has now gotten to a point where the supply has come into the market in a very, very aggressive type of way. And now that the market has established the sign of weakness to the downside, we can expect lower prices to occur. And now we see a series of lower highs and lower lows. We determine the down channel to the market simply because we've had the sign of weakness in the market. Until that market had the sign of weakness that occurred in the market, then we cannot establish any short positions for a long time, because we need to see the sign of weakness in a market that has been marking up in order to have a change of behavior and or potential trend that change in that particular market. In this particular case, we see the sign of weakness ending the bull run, ending the bullish market, and beginning to go further down in markdown. this little correction area that we have in the market, since this flattens out, this becomes the left-hand side of the market. This market is higher. This market goes further through the sequence. This becomes the right-hand side of the market, which is where the sign of weakness would occur, or at least, and for the bulls, where accumulation to the market, where the market would only have to see demand, not a sign of strength, to reestablish the high, and the right-hand side of the market establishes the market to the point where the market gets to the point to where the market gets supply on the right-hand side of the market. As you know, once that happens, the market is over, as we know it, in the uptrend, and now the market will go through a period of days, weeks, months, or years in as far as being bearish down to the downside, and it's a very classical example of the market failing to go lower. Now, in this lecture today, in the three charts of distribution, they all happen to be daily charts, but obviously we can have weekly charts, we can have monthly charts, we can have intraday charts as well. The shorter the time frame that you use in this charting-wise, obviously it's more filtered with noise that occurs. You know, in market may go up 30, 40 cents a crude, back up 30, 40 cents, just based upon the ebb and flow of the market. And we'll see that. But once the market gets to the point where it shows the weakness of the market, then you cannot treat the market as a trading range anymore. You could treat the market from the standpoint of being bearish. In this case, the sign of weakness was inside this trading range. Starting here, and also breaking the ice support that occurs in the market. So you got almost kind of a double whammy of the market happening in the market when it started inside the range, and then continued to do to do downside to the market. And you can see the market marking down. And you can see the range. You can see the markdown phase that occurs in the market. So there are three charts that we've shown distribution. They necessarily don't all look the same that occurs in the market, but we can see that the process is all the same as far as eventual supply came to the market. Supply came into the market, establishing the supply, overcoming demand, which is necessary and needed from a bull market to go into a bear market where you need supply to overcome demand. You clearly see that in each one of these charts. You can clearly see why the market went from a bullish market in nature to one that was in a bearish market through the distribution phase. Again, this trading range in the up move will be considered accumulation because we don't have supply, but once this market establishes the sign of weakness bar on the right-hand side, we know that we thought was accumulation to go up to much higher levels. We now know that the market gets to the point where the market now gets to the point to where it becomes distribution, because we see the wide range bar with high volume on the right-hand side of the market, and what will be needed for the bears would be a sign of weakness, and that's certainly what they established, and that's certainly what they got as far as that goes. So again, we don't need to see a sign of strength in a bullish market, but we do need to see a sign of weakness in a bullish market to turn the market to go back down. So that's very critical and very, very important aspect of Wyckoff, the distribution process in the market marks down. So that will conclude the distribution portion of this starter series lecture, and clearly you should be, by this point, have a very good handle of the process that occurs. And as you know, there is a sequence of 6 lectures that are associated with the series. And any questions, please feel free to contact me at your leisure. And I'll put my email address directly. You can very easily be happy to answer any of your questions as far as that's concerned regarding any of these tapes, as far as that goes. So it's riskybiz@aol.com, and just enter my email in a pretty frequent pace during the day, because that's where most clients correspond with me from. And any questions, feel free to contact me. So thank you for listening to this lecture on distribution, and look forward if you're listening to the other lectures as far as that goes. Thank you very much, and everybody have a good day. Bye-bye.